For those of you who are just joining us, please welcome to, we're going to be starting today with the Economic and Capital Markets Outlook, a 15-minute session that will give an overview of the topics that investors are discussing these days, the impact of inflation and potential recession on public and private markets, and other economic challenges that investors are currently facing. Joining us on this conversation, we'll have Anthony Valencia, partner of East Los Capital, and Elizabeth Grier, member of Cap Table Coalition. Thank you for joining us, Elizabeth. Please take it away.
So thank you so much for having me here. And I'm really excited to go and talk about just the state of the markets. And I know a lot of us have a lot of opinions, and views on where things are going. We have seen just a number of challenges that are showing up both in the capital markets and in the economy. And of course, front-facing is inflation and managing, those inflationary risks with potential recession, trying to manage that, or a soft landing, hopefully. Anthony, I know that, you have significant experience in investing in both the public markets and the private markets. I would love to hear your thoughts on, what is going on out there in the capital markets and the economy, and where you think that things are going to be at the end of this year. And I'd also love to hear your thoughts on, how the Fed is going to manage the inflationary risks and downside risks to the economy.
Sure. Thanks, Elizabeth. Nice to be here. Nice to see everybody virtually again. You alluded to a lot of the issues that I think are generally well understood, Elizabeth, which isn't always the case. And I guess, unfortunately, it is because it's so front and center in everyone's life these days. The Federal Reserve finds itself in a very, very difficult position, arguably somewhat due to their own making, as they probably stayed overly accommodative and, too loose for too long, and kind of, developed a false sense of security, staying around the zero bound, pre-pandemic. And then they were faced with, obviously the pandemic issue and everything that has sprung forth from there. So they're faced with, kind of bad choices and less bad choices. And then investors are holding out the hope that, there is still the possibility for a safe landing or a soft landing. So just to touch on some of the points that you mentioned, everybody's aware of the inflation situation right now. And the last CPI print, I think in April, looking back over the previous 12 months was, right in that kind of mid 8.3 or 8.5% range, which is significantly higher than what we've seen, in the last decade or since the Great Recession. We have the situation with, kind of an oil shock, so to speak, with, very high oil and gasoline prices. We have a real estate market that's at all-time high, and it's probably the next asset class to start to roll over. And there's beginning to be preliminary signs of that. Yep. You have recession risks brought on by, the need for the Federal Reserve to try to fight this very, very strong inflation. So none of this is good. And if you were to make a list of all of the bad things going on in the economy, not to sound doom and gloom, the list is quite long. And if you were to make a list of the things that are going well, and it probably consists of the fact that just the economy still is plugging along pretty well as of today, despite all of the things that on the list that would be bad. There's been a number of false starts in the past with respect to the Federal Reserve saying that they were going to raise rates. Kind of most famously in the last few years is in the fourth quarter of 2018, when Chairman Powell essentially had started to raise rates and tighten, and then was forced by the markets to kind of pivot and back off that and become accommodative again. And we also have now, as of this month, QT, which is basically the Fed shrinking their balance sheet, which isn't something that gets quite the headline press that you'll see with respect to rate increases, and is the Fed going to raise rates by 50 basis points or 75 basis points? But that's equally kind of destructive potentially to the markets and liquidity in the same manner as raising rates are. But it's something that needs to be done. So, maybe let me pause there, and we can kind of dig down into any of the specific areas that you initially mentioned.
Yeah, sure. I mean, I'd love to hear your thoughts on, was the Fed right on just now starting to raise rates. And then also just, going on that is, how powerful do you think the Fed is in terms of really combating inflation if you're looking at more sticky areas such as wage growth and rents, for example? You can't necessarily just decrease rents overnight. And so those sorts of things, how optimistic are you on the Fed actually being able to really tame inflation?
Sure, sure. And, many people have pointed out in the past that, inflation is kind of like that genie that once it gets out of the bottle, it's really, really hard to put it back in. And that's one of the primary dangers of letting it get out of hand because it feeds on itself. The Fed is, a very powerful institution, but it also, that power has to be wielded with, their will to actually do it. And we saw this with, Chairman Volcker, back in the last time we had this sort of inflation issue, because it will make a lot of people unhappy if they are as firm as they need to be. And when I say unhappy, I mean from the perspective of, investors and consumers to a certain extent, because it's tough. It's tough on everybody. And I think that goes to your other question, which was, did the Fed kind of wait too long? And that was an easy answer in my mind, pre-pandemic. And the answer was just undoubtedly yes. We were on the zero bound for way too long. It was an emergency measure because of the Great Recession. And there was a time where they should have begun raising rates. And there were plenty of opportunities and they didn't. Now, then they were thrown a curveball with the pandemic. And then there's, other discussions about was the kind of pandemic related stimulus still too much? Was it too much? The most recent ones that we've had when things seem to be well, Chairman Yellen, Chairwoman Yellen came out recently and kind of alluded to that maybe the last stimulus shouldn't have been as big and whatnot. So the Fed can be very effective, but they need to create some, demand destruction, which is, basically in one way or another, have consumers stop spending so much. One of the dual mandates of the Fed is employment, but quite frankly, if employment were to not be as good, then that puts some pressure on inflation, which in the long run would be good. So what we don't want to see is an extended period that we saw in the 70s, kind of ending in the early 80s with inflation just going on and on and on until finally the Fed said enough is enough, and we're going to do whatever we need to do to tame inflation.
Yeah, so I'd like to just go and touch back on your point on the strength of the consumer. I mean, there's a lot of talk out there, I would say amongst the optimists, that no, just look at, the resilience of the consumer. They're still, going out there spending. I know that one can argue that with the Target earnings recently that you're seeing just a bit of a pullback from there. But in general, there's a lot of talk about a number of trillions of dollars that are still cash savings, in the households, and that, with the strong jobs market and the significant wage growth, that they're still going out there spending. They're saying one thing, doing another. So I'd love to hear your views on that.
Sure. Yes, but like everything that has a limit, because people's incomes are finite for the majority of Americans. And if you were to look at the most recent consumer credit statistics, they're starting to dramatically increase over the past several quarters, which means that people are starting to rely more on credit cards, which would kind of kill the argument that personal balance sheets are so great. And I think one of the factoids that we've all heard just over the years is that the average consumer doesn't have a very large rainy day fund, and doesn't have the resources for an emergency auto or home repair, that sort of thing. Many people actually at all income levels are living paycheck to paycheck. So quite frankly, I've never quite understood this. The consumer's balance sheet are stronger than ever and whatnot. Especially in view of the number of people that pre-pandemic and concurrent with pandemic have kind of dropped out of the workforce. So I think that the consumer is strong is a little bit of a myth that we're going to see quickly come crumbling down if inflation stays where it is these days.
So thank you so much for that point. I do agree with you, but I think that's just really important that we go see both sides. Just to instead of looking at the time, just on the private market. So what are you seeing over there, and how do you think that the public markets turmoil and how that's going to be seeping through the private markets in the next, say, 6 to 12 months?
Sure. I mean, it all flows downhill. It's just more obvious. in the public markets, because we see those prices mark to market every day, and we turn on CNBC or read the Wall Street Journal, and it's kind of in your face. So you see, wow, there's SaaS companies that have come down 80% since November, whereas you don't have that instant price discovery on a daily basis in the private markets. But if there are people in the private equity world like myself, or in the venture world like yourself, Elizabeth, you see it in different ways. You see founders suddenly, inundated your inbox with, hey, we need to raise money. And from your perspective, I'm sure you're saying, well, gee, that valuation that looked pretty attractive 12 months ago doesn't quite look as attractive. And on the PE side, we're seeing things similar to that. We're also seeing, less exits, because the IPO market is dead. So in this first quarter of this year, 65% of the exits in PE land were sponsor to sponsor, which just means one private equity firm selling their asset to another private equity firm. And the numbers have come down. It was 95 billion in the first quarter of this year, and last quarter it was 150 billion every quarter, more or less. So you're seeing the weakening on the private equity side. There's still $1 trillion in dry powder, and that dry powder has been out there for a long time because people were hesitant, on the private equity side due to valuations to get too aggressive, but now is the opportunity. But of course, there's a dual-edged sword to that, is that you presumably may be able to get more attractive valuations, but you're also going to be buying companies at a time when the economy is challenged and limits your use of debt, and so on and so forth.
Yeah, so for me, trying to just focus on the upside here. So I know we can very easily just looking, very bearish these days, but absolutely, I think that a lot of what we're seeing is very cyclical. I know maybe some of the younger generation might not be as comfortable with what they're seeing, but for me, having lived through a number of recessions already, for me, the positive is that it's very cyclical, and I do think that it will be great to see some of the valuations go back down to earth. And that you might actually have some value out there. And yes, it could be trickier on the financing side, but I think it's we could see just more of a healthier, balanced market.
Agreed, absolutely.
So I'm just going to take a pause here and just see if there are any questions. Q&A. So apologies. So I'm looking at Luis Dominguez. Do you think the Fed continue to raise rates until it reaches parity with inflation? Do you see the chance of Volcker-like rate hikes? It's tough for the Fed to fight the supply side inflation. So the main one being, do you think the Fed will continue to raise rates until it reaches parity with inflation?
One of my former colleagues, Jeffrey Gunlock, said a few years ago, I think it was even pre-pandemic, that the Fed will raise rates until they break something. And I think that that's just, the perfect way to look at it. I think if you look at the history of the Fed, just over, since the Great Recession, it would argue that at some point they're going to reverse themselves. It may only be, at one Fed meeting. It may be a pause. People already are in the investment community are debating whether or not they will pause in September. So I think that there's a high probability that at some point, if the breaking of things gets too painful, that you'll see some cold feet on the part of the Fed, and whether it's a temporary or sustained pivot. I think the idea that they will just continue to raise rates meeting after meeting after meeting to get to the point that the questionnaire had asked is probably unlikely.
Yeah. No, thank you so much. Just trying to see if there are any other questions at this time, because I know that we've discussed a lot of different topics. My next favorite topic is on the lovely housing market. If we have, look at the time, we have a couple more minutes here. So I'd love to hear your views on the housing market and where you see things heading in the next 6 to 12 months.
Sure. The housing market is obviously one of the most illiquid markets. And so I think the price discovery to a certain extent, sometimes maybe takes a little bit longer to flow through, the kind of the price discovery channels. But I think we're already starting to see things with respect to mortgage applications slowing. To a certain extent, people buy a payment, right? So they go out and say, what can I afford, and then the price kind of falls out from that calculation, which is why we saw the housing prices increase so much over the past decade plus, is because rates were low and people were just saying, hey, I can afford this payment. Wow, that's a lot of higher price house than I thought I could afford previously, but so be it, I can afford it. So I think with rates going up, it's just it's axiomatic. The housing prices at some point need to go down. Yes, we have some supply issues and shortages and so on and so forth, but at a certain extent, you're going to see the housing market roll over. And even in the kind of back during the great financial crisis, when everybody was focused on the mortgage-backed securities, a lot of the publicly traded home builders fell right away, even before we got to really the depths of the Great Recession, and a lot of buy-side firms, piled into some of these names, either like the Pulte's and whatnot of the world, because they were still down appreciably. And I remember thinking, the real estate market itself hasn't really begun to roll over. And even just recently, I'm seeing the same type of conversations, on the financial news networks, that people are, buying the home builders and whatnot. And yet we haven't even, really seen major cracks in the housing market. So yes, I think the housing market will roll over. It won't be as bad as during the great financial crisis, because we had the mortgage issue there, and the banking issues and so on and so forth.
That's the speculation.
Exactly. But yes, it's going to get much softer.
Oh. Great. Well, thank you so much, Anthony. I think we have reached the time limit. Are there any other questions before I close the panel? Yes. Are there any areas in the public and private markets that are attractive for investments? Yeah. So we mentioned SaaS and growth stocks, perhaps oil higher for longer, et cetera.
Sure. I mean, the way I look at things is it's a valuation issue. So it's not so much that I'm going through all the different S&P sectors and saying, oh, today healthcare looks, more attractive than software or whatnot. To me, it's looking for good, solid companies that, are going to have a commanding presence in their respective vertical that I can buy at an attractive valuation today that I could not have done that, 12 months ago or 24 months ago. So yes, there's been, great destruction in the SaaS marketplace, and some of those look very attractive. There's things in the private market that will look very attractive as valuations come down. But for me, it's really valuation driven.
Yeah, makes perfect sense. Thank you so much, Anthony. I've really enjoyed speaking with you. And
likewise,
it's just
Elizabeth.
what's going on in the markets and the economies. I find it hugely fascinating, and some turmoil, but I think it's we're going to see things through. So I think it's going to look very differently at the end of this year. So thank you so much.
We will get through it as we always do.